Hi everyone, this is Prateek here. We're going to look at a very important concept of the linkages of the three financial statements amongst each other. A very popular interview question in investment banking. If you get this right, trust me, your models will be airtight. So, in this video, I'm going to go into the details of some of the key areas. Some of the key areas where the linkages are commonly seen between the models. Examples are like net income, retained earnings, working capital changes, the interest expenses, the PP&Es, debt issuance, non-cash, and the other things. The idea is very simple. P&L will be connected to your balance sheet. Balance sheet will feed your cash flow statements. Yeah. And cash flow statement will give something back to the balance sheet. It will give back something to P&L. And there will be a flow of information amongst the three statements. And these pillars that you see, they are the major hubs or the interconnectivity nodes of the flow of the information. So let's get into the details one by one between the three financial statements, starting with the P&L and balance sheet. First, looking into the interest and the debt interlinkage. Yeah. So obviously, the debt is a line item sitting on the liability side of your balance sheet, and your interest goes on to your P&L. So obviously the debt, if your company is taking up a debt, it eventually gives rise to an interest expense, which is like the cost of debt. Now there is a very important rule which prioritizes the flow of returns amongst all the investors of the company. Let's say if I have to arrange all the investors of your company, who are your investors? Your investors are your debt investors, your equity investors, and then the promoters. If they have invested their own money in the company, then comes your promoters. So if I make all the investors stand in a line in the in a bid to pay them their returns, then there is a law, there is a rule which says that the debt investors are repaid first. Whatever is then the residual money or income available, that goes to your equity investors, and then followed by the promoter getting their share of returns back. Yeah. So hence debt gives rise to interest. Interest is like the returns to your debt investors. Yeah. Debt investors will be prioritized first, they will be repaid first, which is going to impact the pat. Pat is something which goes to your equity investors, and eventually after you've repaid your equity investors, whatever is the money remaining, it goes to your promoters fund. This is how the cycle moves ahead, and you will see that this rule will be followed in other areas as well. Okay, so I hope this part is clear. The connectivity between the balance sheet and the P&L, because of the debt causing an interest entering into your P&L, impacting the profitability, which is PAT, hence the returns of your equity investors. Yeah. Let's move on to the next interlinkage, where you will see the connectivity between the income statement and balance sheet through the retained earnings. Now you have repaid your debt investors. Okay. Now which are the next set of investors coming in line? These are your equity investors. Your equity investors are supposed to be repaid now. Yeah. So you started off with your first level of profitability in the form of an EBIT or an EBITDA, which we call this as the operating profit. This is the first level of profitability that a company achieves for itself. Now both your investors, which is your debt investor as well as equity investors, will stake a claim on this metric, which is EBIT or an EBITDA, and the first investor or the investor which is prioritized is your debt investor, and hence you repay the interest as a return to your debt investors first. Whatever is the residual cash flow or metric, which comes out to be as your PBT, you remove the mandatory cost, which is your tax. You have to pay tax. If you're making profits at the PBT level, it is mandatory you have to pay taxes. Whatever is the residual cash or metric after that is something which belongs to your equity investors. This is meant for your equity investors as per the rule that I've just now taught you in the previous sheet. Yeah. So in your P&L, PAT is something which is relevant for your equity investors. When it comes to balance sheet, what do you have in your balance sheet? Now under the balance sheet, you have something called as the shareholders equity or shareholders funds. Yeah, you have this section. So net income or PAT goes and connects to the retained earnings which belongs to your equity investors. Yeah. Retained earnings which belongs to your equity investor PAT will get connected to your retained earnings which sits under your shareholders funds or the equity side. Yeah. Shareholders funds or equity represents the cumulative claim of all the equity investors that have invested in this company right from its inception stage. Yeah. And the way to calculate the balance, it's a cumulative thing. How does it work? So just like any other reserve, you have a beginning retained earnings plus the PAT which you have just now connected minus any kind of dividends that you pay out to your equity investors. You will see that happening here. But the flow of connectivity is comparison of apples to apples. You have a metric which is relevant for equity investors, which is PAT. You add it to a reserve or a accumulated claim of all your equity investors sitting on your balance sheet. That's where you see the connectivity. Yeah. Now, moving on to the next set of connectivity, which you will see between the balance sheet and the cash flow statement. Now, here the first line of connectivity is seen in the working capital related line items. You will have things like accounts receivables, accounts payables, inventories, prepaid assets. Now, when it comes to balance sheet, when it comes to cash flow statement, there are simple techniques here where you need to be cognizant of the fact that balance sheet follows something called as the accrual method of accounting, whereas cash flow statement follows something which is known as the cash based accounting method. Now what is accrual method of accounting? Accrual method of accounting is pretty simple, where I'll just write it down here. Accrual method, this is where the timing of the occurrence of an event and the associated movement of cash do not match. It is pretty simple. For example, let's take the example of an accounts receivable. What do we have here? What are accounts receivables? It's a simple concept where, let's say, if you've made a sale of, let's say, 10,000 rupees, you made a sale, your company has made a sale of 10,000 rupees. The client has taken goods which are worth 10,000 rupees from your company. But what he says is that, boss, I will not be able to pay you 10,000 rupees right now. I'm awaiting funds from some of the sales which I have made. I'm yet to get that money. I'm going to take the good from you right now. You can book a sale in your accounts today, but I will be paying you this money, let's say, after 20 days. Okay. He says he's going to pay you after 20 days. Okay. Now, let's say all your clients are doing the same thing. Yeah. Whatever sales you've made to your clients, they all say that, it will take around 20 days for us to pay you. So this leads to a mismatch between the occurrence of the events and the movement of the cash associated with the event. You've made a sale, you've blocked or you've written a date, you've put that sale as on a given date. But has the money come into your company on that same date? The answer is no. It will come to you after 20 days. Yeah. The timing between the occurrence of the event, which is the sale, which is the date which you have booked on your accounts, and the actual inflow of the cash associated with the event, they do not coincide. There is a mismatch, which leads to something called as accounts receivable days. You may have heard this term, accounts receivable days. This is nothing but the actual implementation or the example of the accrual method of accounting, which we just now saw. Now, when it comes to cash flow statement, it completely gets reversed out. In cash flow statement, you don't focus on the mismatch. In fact, you track the movements of cash associated with a particular change of any particular line item. Yeah. To be specific, what is the movement of cash? if the accounts receivable has increased in the current year compared to previous year. We need to look into that. I'll put it here simply. Let's take the example of accounts receivable. Okay, this is my current year, this is my previous year. Okay, current year, for example, is 100, previous year was 8. Now, what has happened in the current year? My accounts receivables have gone up by 20. Yes or no? There is an increase in my accounts receivables by 20. Now, think on these lines whether this event has led to an increase of cash or a decrease of cash. Accounts receivables, if it is increasing by 20, does it lead to an inflow of cash to my company or an outflow of cash to my company? Now, in a way, what does this actually represent on the ground? You have made a sale to your client, and that client has not paid you money for that sale. Your goods, the finished goods that you have sold to that person, the final product that you have sold to that particular company, represents an investment that you have made, right from the raw material stage to processing it to storing it to packaging it to delivering it to your end company. Everything that you have done to convert it from that stage to the finished good stage, everything, that one unit of that end product represents your investments. That investment has gone out of your company, and have you realized the money on that same day? The answer is no. You did not realize the money for that particular sale, but that finished good has gone out of your company. In a way, can I not say the cash has gone out? It has resulted in an outflow of cash, and eventually the ending cash has a negative impact. Cash is going out of your business. The net cash flow goes down because of that, and vice versa. Yeah, which is what is happening here. Increase in accounts receivable leads to a decrease in the cash flow. Decrease in the accounts receivable leads to an increase in the cash flow. Let's look at accounts payable. What are accounts payables? Let's look at accounts payables. Now, in accounts payables, again, let's say I do the same thing. 100 is my current year's balance. Previous year it was 80. Now, accounts payables have increased by 20 in this case as well. Now, what are accounts payables? You flip the situation. You have taken raw materials, let's say from your supplier. You did it today, but you tell them that, boss, we are not able to pay you today. We'll do it after 30 days. So, what has happened? That supplier's finished good, that supplier's investment that was there in the form of that raw material which he has supplied you, for you it's a raw material, for that supplier it was his finished goods. His finished goods represents his investment in that particular product. He may have sourced it from someone else, he may have dug it up, he may have mined it up, he may have excavated it up, he may have had sourced from some other supplier, and he would have incurred some cost while doing that. The raw material which has come into your business represents his investments, and you are yet to pay for that. Yeah, on that day you've received that raw material in your company and you have not paid that. In a way, you've received a notional investment of someone without paying for that. So it's like a cash is coming into your business. Yeah, if cash comes into your business, your cash flow increases. Hence, if the accounts payables are increasing in this year compared to your previous year, there is an increase in the cash flow, and vice versa. Yeah. So there is a trick here, people. The trick here says that, let's say, accounts receivable is an example of a current asset. Accounts payable is an example of a current liability. Yeah. And if I look at the other examples of current assets, for example, inventory, if the levels of inventory are increasing in this year compared to my previous year, what does it represent? It simply represents that, okay, these are the goods which are still lying in my warehouses, which are yet to be sold. These finished goods represent an investment which I have made right from the raw material phase, processing it, converting into a sellable good, packaging it, and it is occupying some real estate of my warehouse, which also represents a cost. Did I realize any cash for that particular finished good? No, because it is yet to be sold. Now imagine that if the inventory levels are rising, what does that imply? It simply implies that my investments in converting that raw material into a finished good have increased. Did I realize anything from that investment? The answer is no. So what is the net result of this? The net result is the cash is going out of your business. There's a cash outflow. Yeah. So increase in inventory leads to a cash outflow, which means the net cash flow will be decreasing. Yeah. And same is the case vice versa. If there is a decrease in inventory, the cash flow will increase. Yeah. So now talking about the trick when it comes to the connectivity between the working capital items in a balance sheet and a cash flow statement is very simple. The trick is to realize or track the movement of cash if certain line items in the balance sheet are changing, especially the working capital. So previously we saw the examples of inventory, we saw the examples of accounts receivables, accounts payables. Accounts receivables and inventory were examples or are examples of current assets. Can I not say increase in current assets leads typically to outflow of cash, and increase in current liabilities typically leads to an inflow of cash? If cash is going out of your business, the overall net cash flow of your business will naturally go down. And if cash is coming into your business, then naturally the net cash flow of your business will increase. So trick is simple. If you spot in your balance sheets year on year, if you compare year on year numbers, and if you identify that line item as being a part of your current asset, the trick is simple. If the line items are increasing, if it happens to be a current asset, simply understand cash is going out, the net impact on your cash flow will be negative, your cash flow will go down. If current liability line item is increasing year on year, the cash is coming into your business, the net impact on your cash flow will be positive, your cash flow will increase because of that delta. Keep this thing in mind. Trust me, building a cash flow statement, linking the accounts receivables, payables, or working capital related line items with the cash flow statement will be a very easy part. Yeah. Let's move on to the next topic, which is the connectivity of balance sheet and cash flow statement when it comes to the long term assets. For long term assets, you typically have plants, machineries, and equipments. Yeah. And typically, the linkage is seen in the form of capital expenditure. Yeah. Now, what is capital expenditure? Let's try to look at this. Where do we find this and what does that mean? Capex. Yeah. Capex is typically the reinvestments that a company makes within its own business. You have two types of capex. You have the growth capex and you have the maintenance capex. Yeah. Now, growth capex typically helps you in increasing the output or the capacities of your business. Yeah. For example, if you are producing, let's say, 1 million units per month, you see that the demand of your product is going very high. The current output is not meeting the demand. The supply is not catering to the demand. Demand is more than the supply. Then in that case, simple strategy would be to increase your production capacities. How do you do that? By spending money on buying plants, machines, building factories, which eventually will give you benefits for more than one accounting year. Yeah. So that type of capital expenditure or expenditure which increases your production capabilities, we call them as capex, capital expenditure. The word capital simply implies that it will give you economic benefit for more than one accounting year. That's a simple concept here. That's why it is a capex. The second type of capex is your maintenance capex. Now, this is critical in nature. It is mandatory in nature. Let's say, visualize the main assembly line or the conveyor belt which carries your product from one processing stage to the final processing stage. Let's say you have a manufacturing company which manufactures certain goods. Yeah. And if that processing line or that conveyor belt breaks apart, then it will be a very challenging situation for the company. Why? Because if you do not get that conveyor belt fixed, you will not be able to produce or produce any kind of finished goods. If you do not produce finished goods, you will not be able to fulfill the orders. If you are not fulfilling the orders, simply your client will not be happy. If your client is not happy, he will not retain you for the next time. If all your clients start doing that, your company will be in a stressful situation. Yeah. So the maintenance capex is a mandatory expense. You have to incur it no matter what. This cannot be deferred, this cannot be delayed. Growth capex, to a certain extent, it is discretionary. Yeah, it is discretionary. You can delay this or you can take it up at a time period where which suits your cash position. Okay, let's say I know that my demand for my product is high. I know that currently whatever I'm producing does not fulfill the demand of my product, but currently the situation is that I do not have enough cash reserves on my balance sheet, or I don't have legroom to take an additional debt, or I already have a huge amount of debt sitting on my books. Yeah, so I cannot take any additional debt. So at that point of time, nobody is going to come with a gun pointing to my head saying that, okay, boss, you have to incur this capital expenditure right now, otherwise your business will be shut. No, that is not happening. Even if you do not incur that growth capex right now, you are still producing, you're still offering the goods, you're still selling the goods, you're still generating business for yourself. You're just not tapping that opportunity that you're losing out because of this thing. There's a demand out there which you're not able to fulfill because of undersupply. You're losing out on that only that part. Your business is going on at this point of time. Yeah, you can decide when to incur this kind of a capex. You can wait for that opportune time, you can wait for that right time, and then incur the capital expenditure. It is discretionary. But maintenance, it has to be compulsory. Yeah. So your capex, as I told you, it is like a reinvestments. It adds to your assets. Yeah. So capex will increase your PP&E because it's building your asset, and in your cash flow statement you will see capex appearing under cash flow from investing activity. Yeah, it forms a very critical part of your cash flow from investments. Yeah. Yeah. Depreciation appears in multiple forms. Appears in your P&L, which is your annual depreciation. Depreciation appears in your balance sheet, but in this case it is the accumulated value of the depreciation and not just 1 year's depreciation. Yeah. And depreciation also appears in your cash flow statement. Yeah, in the form of cash flow from operations. It's a non-cash expense. Yeah. And cash flow statement, as we discussed, it works on the cash based accounting principle. So any kind of non-cash items, they get adjusted back. This is a non-cash expense. There is no actual outflow of cash going from your business. Hence, it gets added back to your net income when you start building your cash flow from operations. Yeah. So this is balance sheet and cash flows. The other important part, that was in terms of the PP&E. The other important part, or the interconnectivity, lies in the intangibles. Yeah. Intangible assets or goodwills. In case of investment banking, goodwill is a very important component. Now, goodwill is something, I'll just quickly show you how do you get the goodwill. What is goodwill? Goodwill is something which is created, or which is nothing but purchase price minus the net asset value of the target company. Whatever is the excess of purchase price which the acquirer has paid over and above the net asset value of the target company. Now, this can also be written as purchase price minus the book value of the equity of the target company. What I'm trying to tell you is NAV is the same thing as book value of equity. How do I understand this? Simple. What is the accounting equation? There is something called as the accounting equation. What is the accounting equation? The accounting equation says that total assets is equal to liabilities plus equity. Yeah, that is what my accounting equation tells me. I'm just rearranging this. Therefore, total assets minus the total liabilities is nothing but it is your equity. Therefore, your net asset value, which is nothing but total assets minus liability, is the same as your equity. Hence, we saw this. Yeah. So, friends, goodwill is an intangible which comes up if an acquirer is paying over and above the book value of the equity, which happens in most of the regular acquisitions. It's an intangible. Yeah. Intangibles. So it will appear on the asset side of your balance sheet. Yeah. And on the cash flow statement, it appears under the investing activities. Yeah. Because you've created an intangible asset. Goodwill is nothing but an intangible asset. Yeah. Intangibles are amortized. Amortizations are non-cash. So obviously you will see them getting reversed in your cash flow from operations. But in case of goodwill, does goodwill get amortized? A very tricky and thought-provoking interview question. Can goodwill be amortized? The answer is no. Goodwill does not get amortized. In fact, it gets tested for impairment. I will not go into the details of what this test of impairment is, how does it get tested into, how what mechanics go into understanding the impairments or not. It's a detailed thing. I will create a separate video on that. For the timing, just keep this in mind. Goodwill does not get amortized. It gets tested for impairment. Yeah. So yeah, these were some linkages when it comes to the long-term assets, PP&E, and the intangibles. Now next is the linkages when it comes to the financing activities. Now, as we saw that a company typically has the sources of capital, which are the primary sources of capital for a company. The first source is debt. The second source is equity. Both these sit under the liability section of balance sheet. Yeah, both these entities, they sit on the liability section of the balance sheet. Now, the linkage between the balance sheet and the cash flow. Now, cash flow, as I told you, it traces the movement of cash associated with the line items. So, any kind of inflow related to debt or any kind of outflow related to debt gets captured in your cash flow from financing activities. You have a separate cash flow in your cash flow statement. We call it cash flows from financing activities. Yeah. So let's see this. How does a inflow work? How does cash come into your business when it is associated with debt? So whenever a company is raising a new debt, whenever it takes a loan, new loan from the bank, or it raises a bond from the bond markets, money comes into your business. There is an inflow of cash. Yeah, it's a positive inflow. Cash flow increases. Cash flow from financing increases when there is a new debt which has been raised. And similarly, if a company is repaying its existing debt, common sense tells us that the cash flow from financing activity should decrease because the cash is going out of your company. Yeah. Now, similarly, let's think on the equity part. How does money come into the business when it comes to equity? How does the cash come into the business? Cash inflow, how does that happen when it concerns equity? So it's simple. If the company is raising funds through an IPO, FPO, private placements, rights issue, or any kind of thing, for example, private equity, any kind of fundraising activity which takes place where the owners of the company are diluting their stake in exchange of cash. That's where the cash comes into your business. Yeah. And how does the cash go out? Any kind of buybacks, any kind of dividends, or any kind of, we see this treasury buybacks happening. Yeah. Where you buy your shares by paying your existing investors. Yeah. When you do that, cash goes out of your company, equity, your ownership increases. So it's a cash outflow. Yeah. So this is how the connectivity works. You have the simple idea is trace the movement of the cash when it comes to fundraising activities, either via the debt or equity, and it will be very easy to connect or find the connection between the balance sheet and the cash flow statement. In this case, it is primarily sitting on the cash flow from financing activities. Yeah. Associated with debt, you also have interest payments, which you can see in your cash flow from operations or financing, depending on whether you're looking at an IFRS statement or a GAAP statement. Yeah. And similarly, when it comes to equity, you will also see dividend payments, which you go out and pay to your equity investors, which eventually reduces your retained earnings and also leads to an outflow of cash from your financing activities. A simple thought process there. Yeah. Now, coming to the last part, the critical one, the cash flow and balance sheet, the ending cash balance. So after you've calculated your cash flow from operations, after you've calculated cash flow from investing activities, and after you calculated your cash flow from financing activities, you add them up, and whatever is the cash that you have generated for in that year, you add these guys up, you will get your cash generated for this year. To this cash that has been generated for a given year, what you will do is you will add up the previous year's cash balance. You can get this from your balance sheet. Okay. Let's say I'm creating the cash flow statement for the year 2025. So previous year's cash balance means this is the cash balance sitting in your balance sheet for the year 2024. What will you get? You will get your ending cash balance. Yeah. You will get the ending cash balance. This ending cash balance has to be linked to the cash and cash equivalents sitting in your balance sheet for the year 2025. And many a times, my friends, this is the plug which decides whether all your calculations in your cash flow statement, in your balance sheet, they are correct or not. Because this is something which is done towards the end, and the moment you link your ending cash balance from your cash flow statement to your balance sheet, if things are correct, if your calculations are correct, if you linked everything properly, then your balance sheet will tally. The assets will be equal to your liabilities plus equity section. The moment when you see that the asset section and the liabilities plus equity sections, they match, you should consider that your calculations are correct. Whatever analysis, whatever linkages you've done in your balance sheet, in your cash flow statement, in your P&L, they are all correct. You've identified the signs properly, you've linked everything properly, you've done a good job, and hence your balance sheet tallies. Okay. So if you keep these framework in mind, people, trust me, looking at a balance sheet, looking at the cash flow statement, looking at the P&L, and their interconnectivity becomes very easy. This is like a flow chart, this is like a map that you can use to check whether your calculations are correct, whether your linkages are correct. If followed properly, trust me, it becomes very easy to create the model in an accurate way. Yeah. So thank you people for watching this video. If you like this video, please give a thumbs up and do subscribe to our channel. This is Pratik signing off. Thank you.